Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView with over 190k reputation points. In today's video, I will be sharing a very interesting Fibonacci trading strategy, and I will be dividing the tutorial into 4 parts. First, I will be explaining the proper way to set up your Fib. Then I will be showing you how to use the Fibonacci tool for this specific strategy. Then I will be explaining how we can integrate order flow, which is the commitment of traders. So how the non-commercials, so the biggest speculators, which are the big players in the market, are basically moving their orders. So how they're shifting their positioning in the market. I will show you how we can integrate this into the strategy. And as the last step, I will show you how to build the strategy and how to test it. So without further ado, let's get straight into the video. Okay, so let's start from the first point, how to set up your Fibonacci. Now, if you take here your Fibonacci tool, which you find here on the left on TradingView, and you just place it, you will see that I have currently set up multiple levels, which are the 0.3 to 0.5, 0.618, which I have it in red for a very specific reason, because it is the strongest Fibonacci level. We will go more in detail about this later, the 0.786. And then I have the extensions, which are the minus 0.272 and minus 0.618. The minus 0.272 is the strongest extension. So also here I have it in red. I will go more into details about this later. So if you set it up in this way, you will see that you will have my exact same Fibonacci, which is basically this one here. So this is how you're supposed to set it up. Now, how to use your Fibonacci tool. Now, first of all, we have to discern about 2 different types of measurements that we do when we're using the Fibonacci. First, we're measuring a correction or we're measuring an extension. Now, if we're measuring a correction, it means that we have an impulse in the market. Let's say, for example, here, we have basically this impulse to the downside. We want to measure the correction, then in this case, what we have to do is take our Fibonacci from the high to the low. So what we have to do is look left and see where's the last time that the market went to the opposite side. Here it was going higher before then melting to the downside. So our Fibonacci will be taken from the high to the low. And what you expect is most of the times the market to go first to the 0.618, which is the strongest levels, as I said many times, and there find the resistance that it needs in order to get rejected to the downside. The other type of measurement that we can do using our Fibonacci is basically for the extensions. So when the market has already basically started the next move to the downside, and you don't know basically where is the nearest level of support and resistance. That is why we use the extensions. In that case, is always the same concept. If you have an impulse and you want to measure the correction, you take your Fibonacci on the previous impulse, which is basically this one here. Now, if you have this impulse to the downside, you have to take your Fibonacci on the previous leg, the previous impulse, which is basically this one here. So the way in which you would be placing your Fibonacci in this case is from this high to this low. And this would give you a first downside target at the minus 27. Okay, so to recap, when you have an impulse in the market, so if you have this impulse to the downside, for example, that we're seeing right now, the market starts a correction. The way in which we can measure this correction is taking our Fibonacci from this high to this low, because from here the market started this move to the upside, and then we had the move to the downside. So if we want to measure this move here, we have to take our Fibonacci on this one. And in fact, we can see how the market went exactly to the 0.618, which is the strongest level. And then now that the market is starting to move to the downside, if we want to measure this leg here, where is the previous leg? Is this one here. So as I said previously, we have to take our Fibonacci from the high to the low of this one here, which gives us a first downside target at the minus 27, which is the first downside target and the strongest one. And when the market reaches that level, you do expect overall to see the market show some kind of reaction to that zone. At least in this case, we will have seen that on lower time frames, because now we are on the weekly. So this is how you use the Fibonacci. You take it on the impulse to measure the correction. You take on the correction to measure the next impulse. Now, moving to the third step, how can we integrate order flow? Now, before we speak about the third step, we first have to define the strategy, right? Because we now know how to set up the Fibonacci. We know how we're supposed to use it for the strategy. But before we can be looking at the actual order flow, we have to define what the strategy is. Now, the strategy here that I want to speak about is using multiple Fibonacci levels in order to determine where we have the confluences of many Fibonacci levels at the exact same area. Let's take, for example, this move here. Okay. Now, in this specific case, we have already seen that we had the impulse to the downside, and then the market started this correction. Now, while the market was starting the correction, essentially, if we wanted to measure our Fibonacci, we had to take it from the high to the low of the impulse, as we have previously seen. And in this case, taking our Fibonacci from the high to the low would have resulted in something like this. So on the weekly, we have this. Now, are there other Fibonacci's that we can take here on the weekly? No. That is when we go down on the lower time frames. In this case, you would go down on the daily time frame. And here, once again, using the exact same rules that we were seeing before on how to place the Fibonacci's, we would be looking also here at what kind of Fibonacci's we can take here on the daily time frame. We don't really have any clear impulses here because we had several candles of different colors. So the only Fibonacci that we can really place also here on the daily would be from this low to this high. Because if the market is to create a deeper correction, so basically a move to the upside, the previous leg would be this one here. So if we take our Fibonacci from this low to this high, we can see how at the moment it would appear that the red lines, which are the strongest Fibonacci levels, so the ones that really we need to pay attention to, are creating a cluster of resistance around this area, because you have both the 0.618 of the Fibonacci taken on the weekly impulse combined also with the minus 0.272 of the Fibonacci taken on this daily retracement. In this case, this is giving you here a confluence of resistance. So at this point, if the market will reach this area, there's good probability to see a rejection to the downside. Let's see if we have new movements, because if we have new movements here on the daily time frame, we would essentially have new legs on top of which we can create and place new Fibonacci's that maybe could create an even stronger confluence of resistance around this zone. Now, what we can see is that, in fact, the market was attracted to this confluence of resistance. Now, let's see if we get rejected to the downside, and you can see that, in fact, the market tested exactly this confluence of resistance given by two of the strongest Fibonacci levels, which are the minus 0.272 extension and the 0.618, and then rejected it to the downside perfectly. Now, let me give you another example in which potentially we could see more Fibonacci levels come into place. So essentially here we have a new impulse and correction, right? So in this case, we would now be taking a new Fibonacci to measure the correction, which is from this high to this low, right? Actually, in this case, it would be from this high to this low. Now, as the market is providing this correction, we have to now go down on the daily time frame, because from a daily perspective, we could have new Fibonacci levels that we're supposed to place. Now, in this case, what we can notice is that if we look at the movements of the market, we had this move to the downside, correction, move back down, and now the market is creating a move to the upside. So essentially here on the daily time frame, similarly to what we have seen previously, if we want to measure this move to the upside, we essentially have to take our Fibonacci on this previous leg here. And if we take our Fibonacci from the low to the high of this previous leg here, we can see that the only area that we currently see as a potential reversal zone would be this minus 0.272 and 0.618, which essentially creates this potential reversal zone. Let's see if we have new movements that could create further levels of resistance. Now, as we can see, that was clearly enough because the market tested exactly our confluence of minus 0.272 and 0.618 and then rejected to the downside very aggressively. Now, let me give you more examples, because there are even situations in which we have more than just these two levels. We have even more Fibonacci levels all aligning at the same zone. Let's see if, for example, here, I can give you even more examples. So you have the impulse to the downside, the market starts the correction. You take your Fibonacci from the high to the low. You can see that there's nothing else that you can take here on the weekly time frame. If we go down on the daily time frame, however, we can see how here on the daily we do have another Fibonacci level that we can take. It's good because I was looking for an example like this. Here on the daily, we can see that here we have a new high and here we have a new low, right? So here we have a new Fibonacci that we can take from this high to this low. Let's see what this gives us. If we take our Fibonacci from this high to this low, we can see that essentially the strongest area that the market would be creating here is this zone here, where we have the 0.618 on the weekly lining up with the 0.786 on the daily. So this is a very strong area of resistance. Now, why would this be stronger than this? Because here we have a similar thing, because the Fibonacci level from the higher time frame will be always stronger than the Fibonacci level on the lower time frame. So if you have here at 0.618 on the weekly, it is stronger than at 0.618 on the daily. So here we have 0.618 on the weekly combined with 0.786 on the daily. So this level will be stronger than this one. So there is a higher probability that we will see the market test this zone and then reject it to the downside. Now, if the market continues to move, we basically have new Fibonacci levels that the market could potentially create, which in this case, the market didn't. We didn't see any new Fibonacci levels getting created. And yeah, that is what we have seen. The market went, tested this zone, rejected it to the downside. Going back on the weekly, let me see if I can give you even more examples on more swings. For example, if we go and see what we had around this area here, what we can see now here, we had a very strong impulse to the downside. So we have to take a Fibonacci from the high to the low of this impulse here. And we're pretty much done from a weekly perspective. We drop down on the daily. Let's see what kind of movements the market is creating here on the daily time frame. In this case, essentially the only Fib that we could take with this one here, but because if we want to measure this move to the upside, we have to take the Fibonacci on this move to the downside, but it wouldn't give us any upside target. So there is nothing interesting, at least at the moment. If the market would create new moves, then it would be interesting. But at the moment, we basically would have this situation here in which we have this move to the downside, move up. So if now from here, the market would create a move to the upside, we could take our Fibonacci on this leg here, which would give us, it would give us at this area here, kind of some confluence of resistance all across this zone. But it doesn't seem like the market is going to test it. So in this case, the market failed to go and test the confluence of resistance, just rejected to the downside. Let's see here what the market was creating. Here we have a very strong impulse to the downside. The market starts the correction. So what we have to do in this case, we have to take our Fibonacci on the impulse, right? As usual, on the weekly, from the high to the low gives us a 50% at this zone, 0.618 at this area. We go down on the daily time frame. From a daily perspective, there is a new Fibonacci that we can take, right? Because we have from here all this impulse to the downside. Currently, we are inside of the correction from this impulse. Therefore, if we do that, what we can notice is that the market here essentially is giving us a confluence because we have 50% and 0.618 both aligning at this precise zone. And here we have another confluence area given by the 50% and 0.618 and 0.32 of the Fibonacci taken on the weekly impulse. Let's see, however, new movements of the market. Now, at this point, this is where things start to get extremely interesting because we're starting to see the move to the upside. So if we want to measure this move here, we have to take our Fibonacci on the resistance, on the retracement in this case, sorry. This move here, clearly the market is not respecting this one. So this one is the one that we are interested in. Let's see if we have another Fibonacci level that would align in this area. And we do, in fact. We have also this minus 0.272, expanding this zone and confirming it as a level at which we have 3 Fibonacci levels, which are all aligning, which are basically Fibonacci taken on this impulse here on the daily time frame. Essentially, we would have the 0.786 that we have previously identified, and we would also have here on the daily, this one here. So in this area, we have this minus 0.272, we have this 0.786, and we have this 50%. And they're all lining up at this area. So What this indicates is that when you have a situation like this, where you have multiple Fibonacci levels all aligning at the exact same zone, which is basically a zone at which you have a weekly Fibonacci level, which is a strong one, there's a high probability for a test of that area and then a rejection to the downside. And what we can see here once again is that the market goes and tested exactly that confluence of resistance and then rejected it to the downside. So essentially, the way in which this strategy works is you need to know how to set up your Fibonacci's, which I have showed you. You have to know how to use your Fibonacci's, so how to place them on the impulses and on the corrections in order to measure the corrections and the continuations. So basically, how to use the Fibonacci retracements and the Fibonacci extensions. And at that point, what you can do is when you have an impulse in the market on the weekly time frame, you can measure the correction and then you go down on the daily time frame and you play with the Fibonacci's, trying to identifying areas in which you have confluences of resistance, right? In which you have multiple Fibonacci levels all aligning at the same zone. Now, how do you integrate order flow inside of a strategy like this? Now, what you do is you look at what is happening on that specific pair. Now, in this case, we were looking at Euro USD. Now, what we would be doing in this case is if we're looking, for example, to short around this area, we know that the market is approaching an area in which we have multiple Fibonacci levels all aligning for our resistance area from which we expect a rejection to the downside. What we want to see from an order flow perspective is on the euro, we want to see net positions getting decreased, right? Because if we're seeing net positions getting decreased, which in this case we were seeing net positions getting decreased, this means that we're seeing shorts added from an institutional perspective and longs getting closed. Now, if we have a market which is approaching a confluence of resistance, let's say we had our confluence of resistance of Fibonacci's around here, the market is approaching it. And you're also seeing from an institutional perspective, net positions getting decreased, meaning that we're seeing shorts added on the institutional side of the market and longs getting closed. At that point, that increases the probability that many shorts will be placed by the big players in the market at that confluence of resistance, because they will be looking at that area as well. And from there, you do expect the rejection to the downside and the continuation. So essentially, how do you put all these concepts together to actually develop a strategy? Now, as usual, the steps that must be followed are: first, you need to backtest and define all your rules, because this is just a general idea of a potential strategy based on this concept. What you have to do is have a clear set of rules. What will be your risk management? How you will be looking then to enter on lower time frames, because in this case you identify the confluence of resistance, but then, for example, you go down, I don't know, on the 15 minutes time frame or on the 4-hour time frame, and you need to wait for certain types of conditions that you must define for yourself, that you have to wait for in order for you to actually place an order. And what you then have to go and do is backtest every single aspect of the strategy, and you continue to tweak it until you find some results which are satisfactory for you. Then you have to move to the demo trading phase, in which you can actually prove the strategy on a demo, and only then you can start thinking about going live with your strategy. But these are concepts that apply to any strategy. You're first supposed to backtest on a lot of data and basically define all the rules of your trading, of your personal trading plan and trading strategy for yourself. Then you're supposed to demo trade it to actually see how you can perform with it on a live market which is actually moving, and only then you can start thinking about actually going and apply the strategy. So I really hope that I was clear, because it was definitely a lot of concepts and I tried to squeeze them in the least amount of time. If you enjoyed the video, make sure that you smash that like button and comment below. It really does help with the YouTube algorithm, and I will see you in my next video.